Kazakhstan has become the clearest stress test of OPEC plus discipline. Its output runs at record levels, regardless of the monthly crude ceiling set in Vienna. In March 2025, Kazakhstan produced 1.79 million barrels of crude a day, against a 1.468 million target, an overshoot of 300,000 barrels. These barrels belong to contracts. Over two-thirds of output comes from foreign-operated megafields under 1990s agreements, predating OPEC quotas. Because the state lacks the legal right to force these operators to cut, the overproduction is a structural reality that compensation schedules cannot fix. Three giant assets drive this volume: Tengiz, Kashagan, and Karachaganak. Each operates under its own investment logic and its own international consortium. The primary driver of the current overshoot is the completion of Chevron's Tengiz Future Growth Project, which achieved first oil in early 2025. Chevron and its partners spent $50 billion to add 260,000 barrels a day of capacity, lifting total output from Tengiz toward 1 million barrels. That single field now produces a volume nearly equivalent to Kazakhstan's entire assigned crude quota. Operators prioritize these economics over international quotas. After sinking $50 billion into new capacity, the incentive is to run that asset flat out to recover the investment. Faced with the barrels it cannot discipline, OPEC Plus has pivoted. The group is unwinding its voluntary cuts in monthly increments, adding supply back to the market to compete away the advantage of serial overproducers. This points toward a significant baseline reevaluation in 2027. Analysts expect the alliance to renegotiate reference levels higher to accommodate the capacity that members like Kazakhstan and the UAE have actually built. This shift suggests that inside the alliance, physical capacity increasingly dictates the quota. For the global market, it signals a structurally better supplied world than the headline discipline implies. For B2B energy suppliers, sales strategies must align with operator economics. Revenue here depends on the physical requirements of the asset, not the politics of the cartel. These mega projects require decades of maintenance and heavy servicing to sustain their output levels. Anchoring long-term revenue strictly to the physical infrastructure and sunk capital of these projects allows suppliers to bypass geopolitical friction and target the most stable spending in the basin.